Hi, friends, and welcome back. I get really excited whenever I get an opportunity to talk about leverage. It's one of my favorite topics to talk about. Not because I love using leverage and abuse it, but because I love talking about it and warning traders about it and explaining the risks that are associated with leverage. And so you should never just look at leverage based on all the benefits it has. It also has a lot of downsides, which a lot of people don't like talking about, which I love talking about. So, leverage essentially is when you use the money you currently have to trade more than you have in your account. So, think of it as a way of you having, say, a certain buying power in the market. And based on the amount you have, we give you times 100, times 1,000 of the buying power. So, obviously, if you're given 100 times or 1,000 times the buying power you currently have, you're going to make more, but at the same time you can also lose more than you currently hold because you're trading 100 or 1,000 times more. So say in your account of, say, I have an example written down here, and I said you have $100 in your account. With a leverage of 1 is to 1,000, it implies that you can trade with volumes worth 100,000. So in your account you have $100, but if you're leveraged 1 is to 1,000, it means that you can increase your buying power from $100 to 100,000. So if you were walking into a store with $100, you'd be allowed to purchase things worth 100,000 and not $100. So it's usually people associate leverage with growing your account fast, right? And they never really talk about how it means you can also blow your account fast. Way of the Turtle talks a lot about leverage and how you should never go to extremes of abusing leverage. Because the problem with leverage, and a lot of people love to use it, is like doubling and tripling and quadrupling. And they never talk about the downsides, which is like blown accounts and things like that, which the Way of the Turtle talks about it a lot. And there's a German guy, his name is Jen Klatt. He runs an institute called JK Trading. His name is Jens Klatt. And he traded at institutional level at a bank and things like that. And he's now spending a lot of his time doing research on leverage. And from his research that I read, is he realized that the consistently profitable traders didn't use much leverage. At most, they used 1 is to 50. I'll repeat, the most consistent traders over 10, 20, 20 10, 5, 10, 20 years consistency, they had one thing in common which he was looking for, which is the amount of leverage. They used a leverage of 1 is to 50. The moment it passed 1 is to 50, they grew closer and closer to blowing accounts and things like that. So the minute it was lower than that, you had a chance of being consistent, which brings us to the American law. In America, the laws are that you can't have a broker which allows the clients to use a leverage of over 1 is to 50. So I think it also matches with Jen Klatt's research, which is that 1 is to 50 is the ideal. So the American system has adopted that and said, if you're a brokerage company, you cannot offer, especially for FX, you cannot offer more leverage than 1 is to 50 because of reckless lending to clients and because it leads to blown accounts. There was a guy in Canada, I think he blew his account to minus 20,000 or minus 50,000, some ridiculous amount because of leverage. I should confirm how much it was, but it was ridiculous amount, probably like minus 20,000 because of leverage and things like that. Another good example is Chris Sarkis. Chris Sarkis, when he left law school, he finished law school, and I think he had made like about 25 million by the time he finished law school. And leverage essentially killed him. If you want to go listen to his podcast, he's done a lot of like podcasts with people, and he's talked about his experience, which is that even though he made like 25 million or however much it was, he ended up being millions in debt because of leverage, which everyone forgets that side of the story. Whenever everyone talks about Chris Sarkis coming out of law school, they always talk about the fact that like he made millions and then he never practiced law and things like that, where in fact he was trying to pay off his debt because he blew all that money. He never actually ate the money he made. He blew it, and he was even in more debt because of the leverage. But even saying that a lot of the consistent traders they found at 1 is to 50 leverage, that may be only a correlation and not necessarily a causation. So it may just be a common factor that they use 1 is to 50, but it doesn't tell us that the reason that they're consistent is because they use 1 is to 50. I would give an alternative opinion and say it's possibly because they were using 1 is to 50 because they already have bigger accounts, and because they have bigger accounts, they have more experience. So they have bigger accounts, they have more experience, so they have less leverage, they have less need for leverage. Whereas the ones who use greater leverage have less experience and smaller accounts. So it seems that the reason why they are smaller and have larger leverage and blown accounts is because they're not using 1 is to 50. But you're not really looking at the underlying factors like the size of the account, the experience, and things like that, which is also a major factor to consider. Anton Creel he has an interesting webinar on his YouTube channel. And when he talked about leverage and liquidity, he talked about how the brokers have this system they use where on the front page of your MT4, they always give you the most common pairs like Euro USD, Pound USD, Swiss franc, yen, the common pairs, the common ones, USD CAD, and those are liquid pairs but not volatile pairs. So they're liquid for the broker, and it's good for them because it's cheaper for them to make the markets for you. So they give you those pairs, and those are the front page. But what he says is that what tends to happen is because they're liquid, they're not volatile. So what you'll find is that everyone tries to increase their leverage to 1 is to 500, 1 is to 1,000, in order to make up for volatility, which the liquid pairs don't have. So he was like, you're better off going for the exotics, which I've always said, like, you're better off going for the exotics because even though they're not liquid, they're more volatile, and then you don't have to use as much leverage. And you'll notice that as you sort of steer your way to volatility and you avoid those common pairs and you go for the exotics, you'll find that you won't need to use so much leverage. You'll notice, you'll see the change and the difference. Yes, they're a bit more expensive, but at least you don't have to over leverage yourself. There's this thing that also happens with like beginner's luck and leverage. So like on your demo account, it seems like there's nothing wrong with leverage because remember you're also starting out, and so there's some element of beginner's luck, and everyone talks about beginner's luck. The Alchemist talks about it in the book. The Alchemist, Ray Dalio also talked about how he made it big. Chris Saka also talks about how he made it big. I also, you see, so there's always like a beginner's luck that comes when you start. And so when you use leverage in the start, it never ends well. So there's always that to consider, beginner's luck at the demo level. Now, once you experience that beginner's luck at the demo level and you start going to the real account, unfortunately, beginner's luck sort of fades away. And that's where, like, you'll see, like, Chris Saka and Ray Dalio talk about how they ended up being in more debt. Even Bill Ackman talked about beginner's luck. And then once you get to your real account, you experience more debt, and you actually experience more debt because of the leverage you've taken or because of beginner's luck. My preference personally is 1 is to 200. For me, that's like ultimately best. It depends if it's, and that's for like the liquid pairs. If it's like the exotics, I'll stick to 1 is to 100 or 1 is to 50. Exotics 1 is to 50, 1 is to 100 is good. But for like the liquid pairs, the common ones the broker gives you, I'll go up to 1 is to 200. I never exceed that. If you want to, then it's like at your own risk if you want to. Like I've seen some people goes to 1 is to 1,000, 1 is to 2,000. And some of them even go as to, like, they start complaining that the broker has too low leverage offering, which goes to reckless lending because, like, so in law, commercial transaction has this thing called reckless lending, whereas banks and institutions like that, they shouldn't just give money away to people knowing that they can't pay off the loans. So before reckless lending laws came into place, what would happen is that microfinancing and banks would give huge loans to people who are unemployed, have stable unemployment, don't understand credit, don't understand interest rate, and they would give them tons of money, and these people would default on their payments. and ultimately you'd have to sell off your house. You'd end up selling your house, your car, and in some instances going to jail. So things like reckless lending and leverage offering go hand in hand in terms of the law offering.